Some big entertainment industry news breaking just this morning. Netflix has won a bidding war to acquire Warner Brothers Discovery. Netflix is paying nearly $83 billion in cash and stock for the film and TV studios.
For 100 years, one name meant Hollywood. Not just movies, not just entertainment. A legacy, a standard. The dream factory that gave the world Casablanca, The Godfather, Harry Potter, The Dark Knight, Game of Thrones. Warner Brothers wasn't just a studio, it was a cultural institution. And then, in the span of just a few years, it was gone. Not burned down, not defeated by a competitor. Quietly dismantled piece by piece by the very people who were supposed to protect it. By late 2025, Warner Brothers Discovery was on the auction block. A company with $34.5 billion in debt.
Discovery is reportedly drafting a plan to split its business. The media giant's mulling separating its streaming and studios businesses from its television networks. This is according to a report out from the Financial Times. Now the company grappling with $39 billion net debt load. And it's that debt that's really been the focus here of the street. But as you can see from the pre-market reaction to this report, it looks like Wall Street is a bit encouraged by what exactly this would ultimately mean here for Warner Brothers going forward. Now, within this report, in regards to that $39 billion of debt, now the Financial Times saying that sources saying that $39 billion could remain with the pay TV networks business if Warner Brothers Discovery were to break up. Now, CEO David Zaslav is examining several options for the company, according to this report, all in an effort here to boost the stock price here going forward. The stock has struggled for quite some time. We have the one-year chart there up on your screen with shares off just about 32%.
A shrinking subscriber base, and a board that had stopped believing in its own future. The asking price was $82.7 billion. The buyer was Netflix.
Netflix apparently submitting a mostly cash offer, a sweetened bid here to buy that company. Chris Palmieri, our man in Los Angeles, joins us right now. And Chris, what do we know? Do we have any sense of what they actually bid? I know the last couple of weeks of reporting was that most of the bids were around that $23.50 mark, and apparently Zaslav and Warner Brothers wanted to see something a little bit more. What do we know?
Yeah, we definitely are hearing that they're edging a little bit closer to that $30 number, depending on how you value things. Big surprise here that we reported was that the Netflix offer is mostly cash, because Netflix's stock has been doing terrific in recent years. A lot of people expected to use that as the currency, and apparently they feel more confident paying cash, and in fact are in talks to raise tens of billions of dollars as a bridge loan to help pay for this.
A tech company built on algorithms was about to swallow a century of cinema. So how does something this big fall this far? The answer isn't one bad decision. It's a series of quiet choices, each one logical in isolation, each one devastating in combination. And when you line them all up, the picture becomes very clear. This is the story of how Warner Brothers collapsed. To understand the fall, you have to understand what was built. Harry, Albert, Sam, and Jack Warner weren't executives. They were survivors. The sons of a Polish immigrant cobbler who arrived in America with almost nothing. Their father pawned his gold watch and his horse to buy the family's first film projector. They started showing movies in small towns for nickels. And they never forgot that the audience was everything. By the 1920s, they had moved to Burbank. By 1927, they bet everything on sound when every other studio said silent films were fine. The jazz singer changed cinema forever. That gambler's instinct defined the company for decades. Risk, vision, and an almost irrational belief that the next story could change everything.
Sidney Furie was the original director of The Jazz Singer, and he came to see me and they're playing our song on Broadway and came backstage and said that he wanted me to be in this movie. And I was thrilled, but I had no intention of leaving there playing our song. And like several months, I didn't really leave that show for many months after that. And he said, well, I want to cast you in this film, so I'll get back to you on it. Well, as it turns out, he didn't get to cast me in the film. They cast Deborah Rathan.
Through the Great Depression, they kept making movies. Through World War II, they kept the lights on. Through the rise of television, they adapted. The studio survived because it was run by people who understood that stories have value beyond a balance sheet. That understanding would not survive what came next. The trouble began not with a failure, but with success. By the late 1980s, Warner Brothers was one of the most valuable entertainment properties in the world. And that made it a target, not for competitors, for Wall Street. The first merger came in 1990. Warner Communications combined with Time Incorporated to form Time Warner. It sounded powerful. It was already the beginning of something dangerous. Then, in 2000, AOL acquired Time Warner in a deal valued at $182 billion.
Well, the vote was overwhelming. That is 99% of the votes, more than 99% of the votes cast voted in favor of the merger. And in fact, the meeting was a good meeting. Large number of shareholders, good questions and comments, and I think very supportive.
It became one of the most catastrophic mergers in business history. Billions in shareholder value evaporated. The cultures never integrated. The logic never materialized. Warner survived, but it had learned the wrong lesson.
People are really looking forward to what Time Warner and AOL have to say about this distribution, and here are the details. In the spinoff, it's an 11-to-1 distribution ratio, which means that for every 11 shares that Time Warner shareholders have, they're going to get 1 share of AOL stock. Now, the shares are going to be distributed on December 9th and start trading on the 10th. And now the big question was about valuation. Well, based on this distribution ratio, CSFB puts the value of AOL at about $3.5 billion.
The lesson it took was that size was safety, that the next deal would be the one that finally worked, that if you just found the right partner, everything would click. In 2018, AT&T acquired the entire company for $85 billion.
Connell, we just got the word. Judge Richard Leon ruling in favor of the AT&T Time Warner merger. His reason was the DOJ did not follow through on the burden of proof. Now, there is a wild card here. A lot of people following this trial over the past several weeks have said, don't put it past the DOJ to just walk away from this. They do have the option to appeal this decision. But for now, as it stands, this could have a ripple effect on several other media deals kind of waiting in the wings of those. Now, one of those decisions involving our own parent company, 21st Century Fox's pending deal with Disney, who wants to buy some of 21st Century Fox's entertainment content. Now, Comcast has also gone on the record saying they plan to make a competing bid for that Fox content. But then
a telephone company now owned Batman and The Dark Knight and Harry Potter and the most prestigious cable brand in television history. AT&T loaded the balance sheet with debt and tried to manage a creative studio the way you manage a fiber optic network, systematically, efficiently, without understanding that creativity doesn't run on a utility grid. 3 years later, AT&T admitted the strategy had failed. They spun Warner off and merged it with Discovery in 2022, and they handed the keys to David Zaslav.
Well, David, look, things have changed a bit since we did the transaction, and despite the fact that, we are doing this relatively quickly, shareholders have still done reasonably well with this decision. I think when you look at, the cash flows that we generated during that period of time, look at asset sales we've made, and, frankly, I have an incredible degree of confidence that David's going to do a wonderful job running this business. And as soon as we put this equity out there, we're going to see the natural re-rating that we intend to see. In fact, I think you're seeing that in the stock this morning where, our shareholders are enjoying the run-up in the Discovery stock right now, given the fact that they're going to own 70% of this new equity. So
Zaslav was not a film man. He was the executive who had transformed Discovery from a science and nature channel into a reality television operation. Honey Boo Boo, Dr. Pimple Popper, Naked and Afraid. That was his track record. Now, he was in charge of the studio that made Citizen Kane. He looked at the books and saw one thing clearly. The debt from the AT&T era was crushing the company. Something had to give. So he cut. He cut staff. He cut budgets. He cut deals. And then he did something that crossed a line the industry had never seen crossed before. He cut finished movies. Batgirl was a $90 million film. It was complete. It had been screened It had a cast and a crew and a release strategy. Zaslav looked at the numbers and decided a tax write-off was worth more than releasing it. The film was deleted from existence. Then Scoob Holiday Haunt. Then Coyote vs. Acme, a $70 million animated feature that got strong reviews at test screenings. He called the process content impairment, a phrase that sounded clinical and meant nothing to the hundreds of people who had spent years making those films. The creative community noticed immediately. Directors started canceling meetings. Producers started asking whether it was worth developing projects for a studio that might erase them before they ever reached an audience. The unspoken contract between a studio and its collaborators had been broken in public. If you follow business stories like this one, you know how rarely the warning signs are this visible before a company reaches its breaking point. If you want to stay ahead of moments like this one, subscribe to this channel. Every week, we analyze how major companies rise, stall, and fall, and what the patterns tell us about where things are heading next. The streaming strategy made things worse. HBO was the most prestigious brand in television. Decades of prestige drama. The Sopranos, The Wire, Game of Thrones. A name that meant quality so consistently that subscribers paid for it without hesitation. Zaslav stripped the name off the streaming service and rebranded it Max. The backlash was immediate and sustained. HBO's own leadership acknowledged the rebrand had caused the service to lose its identity. By mid-2025, the company reversed course and restored the HBO name. Industry observers called it a corporate walk of shame. But the damage was not just to a logo, it was to the logic of the company. Every decision seemed to signal the same thing. Warner Brothers no longer believed in the value of what it had built. The talent responded accordingly. Christopher Nolan, one of the most commercially reliable directors in the world, left. He cited the decision to release films simultaneously in theaters and on streaming as a fundamental betrayal of the agreement studios make with filmmakers and audiences. Clint Eastwood, who had called Warner home for decades, moved on. The director's studio had stopped being the director's studio.
For me, everything I did to do with the camera, to do with editing, was useful experience and stuff that paid off when I came to actually, make features. And really, everything you do, you learn from in terms of any time you're shooting something, short film, particularly short film. When you try to write the script for a short film, it's very difficult to write a short film. I think in some ways it's harder than for a feature to have a complete idea in just a few minutes and have a beginning, a middle, and an end, have an appropriate conclusion. So you learn a lot about narrative structure doing shorter films. But really every job I did, including corporate videos and industrial training films and things where I'd have to go to a company and throw up some lights and shoot interviews, with executives and things like that.
Inside the company, the culture shifted. Layoffs were constant. Restructuring became a permanent state of operation. The creative executives who understood the library were replaced by data analysts who understood retention metrics. Turner Classic Movies, the division that existed specifically to honor the history of cinema, was reduced and sidelined. The streaming service itself became harder to defend. The Max app mixed prestige HBO drama with hours of reality programming. Subscribers who were paying for quality found themselves scrolling through content that had nothing to do with the reason they subscribed. Cancellations rose, the stock fell. By early 2025, Warner Brothers Discovery shares hit a 52-week low of $7.52. The post-merger high had been $30. More than 70% of the company's market value had been erased. The board initiated what corporations call a strategic review. In plain language, that means the for sale sign went up. Two buyers emerged.
Voluminous. That said, the key points are ones we've been making, and of course the lead is no thank you, Paramount, rejecting Paramount's latest bid, if you will, at $30 a share, all cash, for a variety of reasons, many of which we've been discussing over the last few days and over the last week or so as well. But let me get to specifics because there are a number of them here, and they do focus certainly at least starting with what they believe is being consistently misled by, that is, Paramount consistently misleading Warner Brothers shareholders that its proposed transaction has what they call a full backstop from the Ellison family. The Warner Brothers Board of Directors says it does not and never has. There is no Ellison family commitment of any kind. Instead, they propose that you rely on an unknown and opaque revocable trust for the certainty of this crucial deal funding.
Netflix made the first move, a clean, all-cash offer of $82.7 billion for Warner Studios and streaming assets. No cable networks, no CNN, just the library, the franchises, and HBO Max. The market responded immediately. Warner stock jumped. The deal was announced in December 2025, and the industry held its breath. But Paramount wasn't finished. David Ellison, the tech heir who had recently taken control of Paramount through his Skydance merger, had always seen Warner Brothers differently. Not as a nice-to-have, as a must-have, the cornerstone of an entirely new media empire. He kept coming back with higher offers. The Warner board rejected him, then rejected him again, then a third time, and then something shifted. In February 2026, Paramount returned with a revised offer of $31 per share, a total enterprise value of roughly $110 billion. This time, the offer covered everything: the studios, the streaming service, CNN, TNT, the entire portfolio that Netflix had never wanted to touch. The Warner board reviewed both proposals side by side, and on February 26, 2026, they made their decision. Paramount's offer was superior. Netflix had 4 days to respond with a higher number. They didn't. Ted Sarandos and Greg Peters released a joint statement, measured, disciplined, almost careful in its wording. The deal, they said, was always a nice-to-have at the right price, not a must-have at any price. At the number required to win, it was no longer financially attractive.
We're going to start tonight with the fight over Warner Bros. Finally ending as Paramount has usurped Netflix's bid and is acquiring the media company. The takeover bid cost more than $110 billion. For the math nerds out there, that also factors in the debt of Warner Brothers. The deal still needs to be approved by the board of directors for both companies as well as the Justice Department. You may be wondering, what exactly is Paramount adding to its media arsenal here? Well, it includes CNN and other cable channels to Warner Brothers' film studio and streaming platform, HBO Max, just to name a few.
Netflix walked away from the table. They did not walk away empty-handed. Paramount paid a $2.8 billion termination fee for breaking the original agreement. But the prize itself, a century of cinema, the DC Universe, Harry Potter, Game of Thrones, Casablanca, was no longer heading to Los Gatos. It was going to Melrose Avenue. On February 27, 2026, Warner Brothers Discovery and Paramount Skydance signed a definitive merger agreement, unanimously approved by both boards. The deal is expected to close in the third quarter of 2026, pending regulatory approval and a shareholder vote.
Now to a stunning reversal in a high-stakes media bidding war. Netflix says it is backing out of its effort to acquire Warner Brothers Discovery. So that paves the way for our parent company, that's Paramount Skydance, to acquire it instead. Our senior business and tech correspondent, let me get it right, Jolene Kent, has the details. Jolene, when I first saw the crawl on CNN last night, I thought, I'm reading it wrong. What happened?
Gail, you're absolutely right. This was a stunning turn of events. The bidding war appears to be over here, with Netflix bowing out, saying that Warner Brothers Discovery was always a nice to have at the right price, not a must have at any price. And if Paramount Skydance does close this deal, it's expected to have a major impact on the entire media landscape.
The FCC chairman has already called the Paramount deal cleaner than Netflix's, easier to approve, less likely to trigger monopoly concerns. The political winds appear to be blowing in Ellison's direction, but the financial reality is sobering. Warner Brothers ended 2025 carrying $33.5 billion in debt. The combined Paramount-Warner entity will carry more than $90 billion in total. Obligations. That is roughly where the last Warner merger cycle began. Aggressive consolidation, mountains of leverage, and a promise of $6 billion in synergies. In corporate language, synergies means cuts. Ellison has said publicly he has no intention of pulling back on production.
Yeah, of course. So I'll give you a couple of examples. And look, I want to be clear, when we think about kind of our priorities, we think in order to be able to effectively transition this business, the number one thing we need to do is obviously win on content. And that means being the number one destination for the most talented artists and filmmakers in the world, number one destination for the most important sports rights. But when we talk about technology, what we mean is we want to be the most technologically capable media company. And I think, and so I'll give you a couple examples for that. Company, obviously, Paramount Plus, being a scaled streaming service is incredibly important to our business. Right. Right now, the company operates 3 independent streaming services on 3 separate stacks on multiple clouds. That is the most ineffective way to do it, and it is also the most expensive way to do it. So one of the first things that we're going to do is obviously converge all of those platforms onto one unified tech stack in one cloud.
30 films a year. 15 from Paramount, 15 from Warner. The industry is watching that promise very carefully because Hollywood has heard similar commitments before, and it knows how they tend to end. What is already clear is this: the independent Warner Brothers is gone. The question now is whether what replaces it honors what was built or simply reorganizes it for the next round of debt management. 2 storied studios, 1 balance sheet, and a combined library that spans from The Godfather to Batman, from SpongeBob to The Sopranos. Whether that becomes something greater than the sum of its parts or simply the most expensive restructuring in Hollywood history will take years to answer. The famous water tower in Burbank still stands. The shield is still visible on it. But for the first time in a century, nobody is entirely sure who it belongs to. The Dream Factory has changed hands, and the rest of us are just waiting to see what gets made next.